Hi, this is Mijun from Mijusilon University. Today's Mijusinyo Sol for November 17th starts now. Welcome to Mijun, where we continue to uphold the fundamentals of United States stock investing as always. Mijun family, I hope you all had an enjoyable and relaxing weekend. As for my family, our weekend was very busy, just like during the holidays, but especially this past weekend. We weren't allowed even a single hour of rest. But instead, there were a lot of exciting and enjoyable things. Well, since I considered the Mijun fam members my family, let me brag a little for a moment. Last Saturday, my son participated in a violin competition. He entered the competition and got a good result. His hard work paid off. Also, on Saturday and Sunday, there was a swimming competition as well. So, in this hot weather, even though there was a fan next to us, sitting at the edge of the pool and cheering hard, the weekend just flew by. When living such a busy life, we tend to forget about our own lives as myself and my wife, and just focus on being mom and dad, letting our own lives just pass by. When it comes to investing, about today's stocks, about investing. When it comes to today's stock investment, about today's investment, about today's stocks, about today's stock investment, about today's stock investment, about today's stock investment, about today's stocks, about today's stock investment. When that time comes, the Mijun family members will feel even more present to me. Anyway, as I continue to run the Mijun channel for a long time, I think I should keep maintaining a strong relationship with all of you. Alright, it's Monday, November 17th. Here's today's big news. Let's get started. Today, I'll begin by reading a comment from one of our valued subscribers joining this broadcast. The first comment is from Hong Ji-yeon, who left this message 2 days ago. Hello, I listen diligently every day, but I can't trade stocks as well as Mijun. Anyway, I can't seem to hold on to cash and end up buying whenever the market dips, but when times like this come, I can't buy. Yesterday, when Mijun added 6 stocks, I was getting anxious, and then late at night, I saw the futures market dropping sharply. So I sold my stocks that were in the negative, thinking I'd buy again if the correction got deeper. After dropping the kids off at school in the morning and coming back, the market had already rebounded, so I missed the chance to buy more. Before, you said while looking at the Nasdaq index's 2 moving averages that you would buy more first at the 21-day line and then later at the 51-day line. I even wrote it down in my notes, but I still missed it. If I had some cash left, I would have bought more even yesterday, but it's not easy to take profits when things are going well. The ones with bad momentum, I'm practicing cutting my losses these days though. I wanted to keep the coin-related stocks until the end, trusting Mijun, but I sold them anyway. I felt empty today, but watching Mijun's late stream and his positive insights comforted me, so I'm writing this. Mijun, how do you take profits when you're in the green? Last time, you briefly mentioned setting a stop loss at 20% and a take profit at 30% or making your own standards. I'm curious about your standards, Mijun. Thanks for always broadcasting. Last time, I gave an example like setting a stop loss at 3% and a take profit at 7%. Actually, I think this is a more suitable investment method for short-term investors. The reason we invest for the long term is because it's a really great advantage. If the returns don't increase, if the returns don't go up, 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 if the returns don't go up. There are many stocks I've never tried. That's why it's actually much harder to time taking profits. At times like this, when is the best time to take profits? In my opinion, to take profits well, you should never evaluate stocks absolutely, but rather evaluate them relatively. What I mean is, this is a stock that I've enjoyed tremendous returns on over the past 5 years, but it seems like it might still go up a bit more in the future. Then it's not easy to sell it. Whenever you check your portfolio, you see gains like plus 500% or 700%. But the problem is, looking ahead, it seems very unlikely that this will go up another 2 or 3 times. In times like this, I think boldly selling is the right investment strategy. If you evaluate it in absolute terms, you can never sell, because it's not just about dropping. It could go up another 10%, 20%, 30%, or even more than 50% in the future. But if you compare this stock with other stocks, in my opinion, it's a bit difficult for this stock to go up 3 or 4 times more from now. However, this newly discovered stock called B has the potential to go up 5 or 6 times in the next few years. Here, you should confidently move your investment funds from your cash cow stocks like Hyoja and Narusa into the new stock. And you can never make this kind of decision if you evaluate stocks in absolute terms. Only investors who evaluate stocks relatively can follow this pattern. That's what I want to tell you. Because of things like this, I want to emphasize once again that in order to make profits, we must use relative evaluation, not absolute evaluation. Since this is the first broadcast of a new week, let me read one more comment. This comment was left 2 days ago by someone using the identification Silver. Hello Miju, thank you for always providing such high quality content that's only helpful. As a subscriber and member who hasn't been investing in stocks for very long, I have a question I'd like to ask. Regarding the fear and greed index that you show every day, is this indicator originally a highly volatile one? You've left a very important and interesting question. Is this what you mean? You're looking at the S&P 500 chart right now. Anyone can see that it doesn't look extremely fearful. And it's currently bouncing back successfully from the 50-day moving average. So compared to the peak, the market has only dropped about 4% or 5% at most. But why has the fear and greed index dropped to such extreme fear? It's a bit hard to understand this part. What's the reason? Regardless of the current stock price trend, the fear and greed index is an indicator that shows the market situation, the market sentiment, what we call sentiment. This index points to that sentiment because it combines and sums up 7 different indicators. Some indicators, of course, show the current stock price trend. But what's even more important is, for example, there are put and call options. If you review it once again, there are 2 types of options. One is the put option, which bets on a decline, and the other is the call option, which bets on a rise. But what are these put and call options? It's about measuring which side has a higher ratio. But recently, this ratio has been increasing. It's trending upward, right? That means there are now a few more people betting on a decline. That's why the fear and greed index keeps dropping. That's all I can say about this. It's the same with the VIX. The VIX was staying at a very low level and then started trending upward, right? Because of this, you can see the fear and greed index dropping even more. There are also various other indicators that reflect the market sentiment. For example, what we call safe haven demand. When bonds become very popular, the returns on stocks and bonds don't differ much. That's what's happening right now. The difference is almost 0. It's getting really close to 0.00. That means there's really no need to take on risk by leaving bonds and investing in stocks. Lastly, let's talk about junk bond demand. This is an indicator that shows the current state of the economy. If the economy is doing poorly, fewer people want to invest in risky bonds called junk bonds. So when demand decreases like this, the interest rates have to go up. Therefore, the worse the economic situation gets, the bigger the gap becomes between the yields of junk bonds and high-quality bonds. If you look at the current graph, there wasn't much of a difference in the past, but suddenly it shot up. It's currently labeled extreme fear, showing a dramatic level of fear. Now, since the fear and greed index is a mix of various indicators that show the current psychological state, this index, it can drop sharply. The volatility can be quite severe, so it would be good to keep this in mind. On the other hand, the market score provided by ChoiceTag is a bit different. As Kim In-jung has explained many times, what about the market score? It compares the ratio of stocks with buy signals to those with sell signals. So right now, as I mentioned, the market has dropped about 5% from its peak. That means there are a lot of stocks with strong momentum, and that's why the score is actually at an overbought level right now. So in my view, the market score reflects the market's momentum even better. Conversely, the Fear and Greed Index shows the market's sentiment. If we look at the results of the American Association of Individual Investors survey through the market system, through this system, right now, through this system, through the system, through this system, through the system, right now, through this system, through the system, through the system, right now, through the system. This is the Monday broadcast. Today, I will neatly summarize the United States stock market trends from the past week. First, let's take a look at the S&P 500 map, which gives you an overview of the mood in the United States stock market. I've set the period to 1 week ahead. This is the situation over the past week. At first glance, it looks mixed, about half green and half red. There is a bit of an optical illusion. That's because the top 3 companies by market capitalization are all green. That's why when you look at the area, it feels like they're about the same size. Actually, the market breadth has narrowed, and there were more stocks that fell. And another characteristic is that the number of stocks that surged or plunged over the week is very limited. There aren't many standout stocks, right? Well, for example, in the healthcare sector, you can see several very bright green spots, so we can figure out that healthcare surged. The stocks that dropped were Tesla, which plunged, and Oracle, which fell more than 6 to 8%. In addition, Intel dropped by nearly 7% over here. Dell Computer fell by as much as 8%, and AppLovin dropped by more than 10%. Now, except for a few stocks like these, there weren't any stocks that rose or fell sharply. It's dull. What that means is, after a week of tug of war, things are pretty much even. This is a very positive sign, because for the past 2 or 3 weeks, the mood in the United States stock market hasn't been good. So, the declining United States stock market is finally seeing a more even fight. As this tug of war continues, there's a possibility that the mood could shift upward again. This can be interpreted positively. Anyway, over the past week, the downward trend was stronger. Only 2 indices went up. In 5 days, the Dow Jones rose 0.41 and the S&P 500 rose 0.14. But all the other indicators, or the other indices, showed negative numbers. It's the same when you look at the performance by sector. Only 4 sectors were positive, and the rest all ended in the negative. Now let's take a look at the breadth of the market. It fell to 43.3. So for now, among the 500 major companies that make up the S&P 500, the number of stocks with a good trend is still very limited. Therefore, if the S&P 500 is to successfully rebound again, the market breadth needs to improve a bit more. I want to emphasize this point. Next is the performance of Mijon Top Pick. Only 2 stocks showed a positive performance over the week. That highlights how badly artificial intelligence beneficiary stocks did last week. First, Advanced Micro Devices performed the best, rising by 5.68%. Second, fortunately, Diamond's top pick in the United States NVIDIA also went up by more than 1%. The rest all ended in the red. Taiwan Semiconductor Manufacturing Company fell 0.59%, Google 0.87%, Meta 1.97%, Broadcom 1.99%, Palantir 2.20%, Celestica 3.48%, Persla 5.44%, and Tesla 5.86%. Bitcoin fell 6.51%, Talon Energy 6.64%, Ethereum 6.81%, Coinbase 8.13%, Credo 11.06%, Bitmain 14.49%, Strategy 17.43%, B2 18%, and ProShares Ultra Ether Exchange Traded Fund over 19% the worst performer. As summarized earlier, the United States stock market has been correcting for the past 2 weeks. Last Friday, many artificial intelligence beneficiary stocks trended upward overall. And now, at the point where it closed in the positive, it hit 50 and then rebounded. This is technically very positive. And over the weekend, there was a major positive development. So in today's broadcast, I'll explain what that major positive news announced over the weekend was. So what is it? An incredible piece of news was discovered. Warren Buffett's Berkshire Hathaway made a large new purchase of Google stock. Now, let me briefly introduce what exactly happened. It was revealed through the 13F filing disclosure that Warren Buffett's Berkshire Hathaway has established a new position in Alphabet, the internet and artificial intelligence giant. And with this, as of the end of September, Alphabet has become the 10th largest stock holding of Berkshire Hathaway, which is incredible news. Now, first of all, I think there may be some people joining this broadcast who have recently entered the United States stock market. Let me first explain what a 13F filing is. In the United States, investors managing over $100 million in investment funds, more than $100 million, are required to disclose all their holdings every 3 months, and that's what we call a 13F filing. The time when this filing is made public is within 45 days after the end of each quarter. So what that means is March is the end of the quarter, right? So if it ends in March, then by April and up until May 15th, they have to make the announcement. For the June quarter, since July and August come after, it must be announced by mid-August. And now, what's being disclosed this time is based on the end of September, so the announcement must be made by mid-November, by November 15th. Now, let me show you something a bit more interesting from this announcement. The stock that was bought the most this time was Google. This part is very positive. Now, if you look at the amount, it's $4.34 billion. You can see that a huge amount of money was used to buy a large quantity of Google shares. And Apple was sold again. In the case of Apple, they sold as much as $10 billion worth all at once. And below that, they also sold some shares of Bank of America. They sold Apple and used the money to buy lots of Google shares, seeing Apple as declining and Google as on the rise. This way we can get a sense of Berkshire Hathaway's strategy. And it was briefly mentioned in the article as well. The key point is that, despite being a first-time purchase, it already made the top 10. Therefore, going forward, it's highly likely that Berkshire Hathaway will invest a significant portion of its holdings in Google. That's how you should see it. Now, here's one interesting point. This time, Berkshire Hathaway wasn't the only one to buy a large amount of Google stock. Now, I'll show you the movements of other major smart money players as well. First, let's talk about Whale Rock. What about Whale Rock? This institution has achieved the highest returns in the past 3 years. Let me show you briefly. Here is Whale Rock Capital Management's performance chart from the past 3 years. It's been the sole top 20 entry for 3 years. If you look at the holdings return, the annual average is 54.85%, and the total return over 3 years is 271.31%. And that's how good Whale Rock is at investing. Now this time, Whale Rock sold off a lot of Celestica. And then there was a new top pick they bought, and that stock is Google. As you can see, they bought Google stock for the first time, and it's their largest purchase, right? They bought $284 million, and on the other hand, for Celestica, they sold off $405 million. Besides Google, as you can see here, they also bought $792 million worth of Meta stock. That's not all. This time, another strong investing institution, 3G Capital, achieved a 200% return in 3 years. Recently, 3G Capital made major new purchases, including 2 top picks bought in bulk. Now, let me show you which stocks they are. At Google. If you buy Google at Google. If you buy Google at Google, you just need to buy Google at Google. If you buy at Google, if you buy Google at Google, Google schedule. I sold Powi and Nvidia. After that, there was a top pick in the United States that I bought in large quantities. And the main character is Google. They bought as much as $1.27 billion this time, and if you look below, there's another Google. So they bought both Google Class A and Google Class C shares, as you can see here. On the other hand, they sold a lot of CoreWeave. They also sold $302 million of Nvidia as their fourth stock. Now, you might be worried that they sold off all their Nvidia shares. Let's scroll down and take a look at the current rankings. For Philippe Lafon, Meta remains the largest part of his portfolio. Even though the stock has dropped a lot, he's still holding on to the #1 ranking. He made some additional purchases, so by buying almost 10% more, he's showing continued confidence in Meta. We can see this here. Now, the second ranking is Microsoft, and the third largest holding is Taiwan Semiconductor Manufacturing Company. The fifth is Amazon, the sixth is Broadcom, and in eighth place, Nvidia is still included. So, although they've reduced the proportion by about 14%, it still takes up a very large portion of the portfolio. Now, in the case of Google, whose proportion was increased by 259%, it's ranked 10th. That's how I can summarize it for you. Most investors usually do their homework well. They focus on preparation. Here, what I mean by preparation is prediction. So they waste too much time and energy just trying to predict what will happen to the stocks in the future. But in my opinion, truly skilled investors look back at the past a lot. If they've made mistakes, they work hard to make up for them. And as they gain more experience, they don't repeat the same mistakes. So in that sense, Google has given us investors a very important lesson this time. Now, as you can see on the screen, on May 12, 2025, I sold all my shares in 2 stocks and bought more of 2 other stocks. One of the stocks I sold completely at that time was Google. I sold all 82 shares, you know. If you check the transaction price, it was $158.44. At that time, concerns about Google were growing a lot and the momentum was at its worst, so I focused on a momentum investment strategy and decided that it would be better to sell Google for now. That was on May 12th. After the 10th, on May 22nd, just 10 days later, I shared this content with you all. Google held the I/O conference. While summarizing, I ended by saying, now, let's see what I said about Google. I underestimated Google, a company where the world's top talents are gathered. The technology dominating our era is artificial intelligence, and I was once again reminded that Google is one of the leading pioneers driving the artificial intelligence revolution. Reflecting on my mistake, I posted an article about accounting, and here I didn't just regret my wrong decision, I took action. May 22nd. Some safe stocks percent operating expenses. Step back. He said things will go really well. Everyone, Mr. Douglas. It's one of the twos. Now that momentum is back and improving, it's okay to buy. At the time, it was a tough choice. The stock had fallen 10 ranks, so buying again wasn't easy. Now, but if I had hesitated here, feeling reluctant to buy again because I had already sold, I would have made a huge mistake. Because right now, Google's stock price is at $276.41. And since there was some big news last weekend, the stock price has surged more than 4%. So it shot up to $287. That means even from the new price at which I bought, it has surged more than 70%. So at that time, even though it had gone up by 10% again, I was conflicted about whether it was right to buy again. That wasn't necessary. So the investment lesson we need to learn from this experience is that we are not perfect, so we often make mistakes. Sometimes we sell stocks we shouldn't sell, and sometimes we buy stocks we shouldn't buy. At times like that, we can't help but take a loss. However, even if we take a 10% or 15% loss, when we realize we've made a wrong decision, we need to reverse that decision. Only then, in the mid to long term, can we recover from our mistakes. So, through this stock called Google, I personally had a very valuable experience, and I want to say that you all have also gained indirect experience from it. Last weekend, because Warren Buffett's Berkshire Hathaway bought Google, my story got a bit overshadowed. Actually, this week, there is an extremely important earnings result coming up, and that's Nvidia. Nvidia will announce its earnings results on Wednesday, November 19th. And this week, honestly, it's not an exaggeration to say that Nvidia's earnings results will determine the fate of the United States stock market. So, The last content we've prepared for today is the Mijon podcast, and the article we'll be sharing with you in this podcast is as follows. This article strongly predicts impressive earnings for Nvidia. Now, let's see what reasoning the author uses to forecast such strong results for Nvidia's earnings. I think it would be good for you to listen to it yourself. That's all for today's Big Stock News on November 17th. Thank you for joining us from the start to the end this week. As I mentioned earlier, there are a lot of major events this week as well. Nvidia, his earnings results are also coming up, and government reports that haven't been released for a while are finally starting to come out. So, although the September employment report is a bit late, it will be released this week. Please check out these important news updates, the Mijon All-in-One membership, and Mijon YouTube broadcasts with the show. Let's keep fighting together until we all retire by investing in United States stocks. Have a happy day. Thank you. Hello Miju family, it's a pleasant Friday morning. Fridays usually feel lighter because the weekend is coming. But even this weekend we have a full schedule, so these days I'm working hard with the help of red ginseng.
Hello everyone, I bought Baraka yesterday and will try to get through the next few days with it. Next week, I definitely need to make time to run for 30 minutes each day. Yes, these days all the attention in the market is really focused on just one place. Nvidia's earnings announcement is coming up.
Yes, that's right.
It's basically the leading stock of the artificial intelligence era, like the sun itself. Every single earnings report makes the entire market fluctuate. So I think that's why everyone is curious. Will this tremendous growth really continue?
Yes, so today we've prepared a really interesting in-depth analysis article. These pessimistic and optimistic outlooks are closely linked.
That sounds interesting.
Let's take a look at this to get an early glimpse of Nvidia's earnings, and let's talk together about what we should pay attention to.
Sounds good. Let's find out why this analyst is focusing on Nvidia. What risks should we watch for? Let's review the main points. Should we begin with the positives first? You can really feel the power of money, right?
Hyperscalers, Microsoft, Google, Amazon, Meta, yes.
Non-tech companies,
These companies have spent a total of $368 billion on data centers and computing power just in the past year. But what's important here isn't just the amount. This investment isn't some fleeting gold rush. Now, it's turning into a fixed cost or operating expense for the artificial intelligence era, similar to electricity or water bills.
So it's now a necessity, not a choice, right? To run artificial intelligence services, you always need Nvidia chips, correct?
That's right. But
the article mentions a more interesting point beyond this new investment.
I found that part about the replacement cycle really interesting.
It means data center GPUs last only 1 to 3 years, shorter than expected.
Yes, that's right. It's just like smartphones. In the past, we used to use them for 4 or 5 years. But these days, because of new features, it's become natural to replace them every 2 years or so. Data centers are following a similar trend. So, at the end of 2023, you know those first-generation artificial intelligence chips that were used during the ChatGPT craze? The analysis is that the time to replace those chips is coming soon. So, in addition to the demand for building new ones, there's also demand for replacing the old ones with new ones.
It's a double boom, so the demand is doubling?
It's coming in, wow.
This is really powerful, but there's always something that holds back these good prospects. China.
You mean the China issue? Yes.
That's right. Isn't everyone a bit anxious because of the United States sanctions?
That's right. But this article gives a highly paradoxical analysis.
What kind of analysis is it?
You know, there are Chinese competitor chips like Huawei's, and the problems with poor quality, overheating, and system crashes are just too serious. I've heard people say the yield rate is only 5%.
Percent? That's barely usable.
Yes, so ironically, this situation is actually making Nvidia's technological superiority even stronger in the Chinese market.
Ah, so the sanctions have actually become an opportunity.
In the short term, yes.
It's an ironic situation. But there can't only be good things like this. What risks did the article point out?
Not everything can be perfect, but there were only 2 main points. First, the biggest customer is becoming the biggest potential competitor.
Like Google or Amazon?
Correct. Google is investing heavily in its artificial intelligence chip, the TPU, while Amazon is doing the same with Trainium and Inferentia.
So they're trying to rely less on Nvidia, right?
That's right. They're desperate. And the second risk is the price itself.
The high valuation, yes.
The stock is trading at over 28 times sales, indicating expectations are too high.
That's right. So if the fourth quarter outlook falls even slightly short of expectations, there's a risk that the stock price could fluctuate significantly.
That's true. In fact, there are reportedly many put options in the market betting on a stock price drop.
Considering both the optimism and pessimism, what's the analyst's final conclusion?
So should we buy or not?
Conclusion, they kept a strong buy rating and set the target price at $351. They believe that the strong demand from data center expansion and the upcoming replacement cycle far outweigh the risks like in-house chip development or high valuation.
That makes it clear. There's strong momentum from big non-tech investments and the replacement cycle, but also major challenges from in-house chip competition and high stock prices.
Yes, that's exactly right. So, what should we pay the most attention to in this announcement?
We shouldn't only focus on sales or profit numbers.
We need to look past those numbers. During this earnings conference call, listen carefully to see if the Nvidia executives directly mention terms like maintenance capital or replacement cycle. If these words come up, it could be the strongest sign that the artificial intelligence market is moving beyond the explosive initial investment phase and entering a stage of sustainable demand.
I hope this information will be of some help to you on your investment journey.
Thank you for being with me today. Have a great day.
Thank you.
Thank you. I've heard of AM Edge's previous questions. FLD. TF2. Let's walk together on this beautiful downhill road. A happy investment with Michu, all of us together until the day we all boldly retire as national poets.